Hello. Good evening. Thank you for joining us. My name's Brannon Moncrief. I'm with McLaren and Associates. I'm broadcasting live from Austin, Texas this evening, and I'll be covering keys to maximizing your outcome in a DSO affiliation. We're going to cover a lot of ground tonight, and I want this to be as interactive as possible. So, as we go through the presentation, if you have a question, I encourage you to click on the bottom right-hand side of the screen, type in your question, and hit send. Or if you prefer to text, feel free to send me a text message at 512-660-8505. So don't worry if you missed that number. It's going to be on the bottom of the screen throughout the presentation. And if you see me checking my phone, I'm not checking my Instagram. I am looking at your questions. So with that, I will hop right in. So I'll start off telling you a little bit about McLaren Associates and myself. I have over 20 years of experience in the dental industry, about a decade as a banker. And the past 12 years, I've served as a dental practice broker and sell-side advisor. About 12 years ago, I purchased McLaren Associates. So I've got a tremendous amount of perspective in practice transitions. I've now been involved in the sale of over 1,000 dental practices, both on the finance and sell-side advisory side of the business. I've seen everything that can go wrong and right with the practice sale. And most of my time these days are spent in the DSO private equity world, representing large practice owners and emerging DSOs who are looking to pursue a DSO affiliation or a private equity partner. We could not do what we do without our amazing team. We have a dedicated team of 10, and that includes people from all aspects of the dental industry. We have finance people, bankers. We have a CPA on the team. My brother and business partner is a former Patterson rep. We have a Wharton MBA and Penn Law, former investment banker on our team, as well as a former dentist. So a fantastic team that's dedicated to serving dentists in their practice transition needs. A little bit more about McLaren. We've been around for 35 years. We've done over 1,000 successful practice sales, closed over 1.2 billion in transaction volume. And as I said before, we really specialize in providing sell-side advisory for DSO transactions, large practice owners who are considering affiliating with the DSO. We're headquartered in Austin, Texas, which is normally a warm place, but today everything is frozen over, and it looks like we're going to have more of the same tomorrow. So my drive home might be a little treacherous. We serve DSO clients nationwide, and we often get asked, we built our business doing doctor-to-doctor practice sales, doctor-to-doctor transitions. Why did we get involved in the DSO space? Well, being in Texas, we were kind of on the forefront of the private equity DSO consolidation. We saw a lot of the large practice owners in our backyard begin to make the decision to affiliate, to partner with DSOs. And we knew that they didn't really understand how private equity views the value of their business. Most doctors don't know what their EBITDA is. They don't know how private equity looks at valuation. They don't know the complexity of the deal structures that are involved in that realm. And they also were not creating a competitive environment. They had no optionality. They were selling to the first and only DSO that knocked on their door. So we knew that we needed to get educated about the DSO option. We needed to get involved in the private equity space. We need to build out a team and a process to represent doctors so that they make informed decisions about the future of their practice and ensure that they maximize their outcome if and when it's the appropriate transition strategy to look to partner with a DSO. So let's talk a little bit about industry consolidation. What is happening in the dental industry? Why is private equity so interested in our industry? And why are they consolidating at such a rapid pace? So private equity in general has a huge amount of dry powder. Capitalism is structured so that the rich get richer, and a lot of the wealthy people in the United States have pushed a lot of their capital, not only into the stock market, but also into alternative investment opportunities like private equity. High risk, high return. So it's a good way for wealth managers to diversify our portfolio. So it's pushed a ton of cash into the private equity realm. And when you combine that with inexpensive bank debt, yes, it's getting more expensive. We'll talk in a little bit about how rising interest rates are impacting the DSO space, but still we're operating near historically low interest rates from a commercial debt perspective. So when you combine a lot of cash with inexpensive bank debt, it's going to end up with private equity looking to deploy a lot of capital in stable, highly profitable, highly fragmented industries like the dental industry that can benefit from leveraging economies of scale, that can benefit from DSOs taking the administrative burden off of practices and supporting them from that perspective and allowing doctors to retain clinical autonomy. So why have a lot of doctors started to look at the DSO option? I would argue that, DSO was a 4-letter word until about, let's say, 5 to 7 years ago, when I think DSOs finally learned to stay in their lane. They learned that their role is to empower doctors to focus on clinical quality of care and on the patient experience, and to stay in the background and provide administrative support to their dentist partners. So because they've learned to stay in their lane, they don't rebrand practices, they don't impact the clinical autonomy of the doctor, most DSOs, it's allowed practice owners to look at the DSO transition option as a truly legitimate option to transition their business, take some chips off the table, and get some help from an administrative perspective. DSOs have also invited dentists to participate in the financial arbitrage that private equity investors are experiencing in the space. So they've allowed dentists to retain and roll equity, to actually invest at the DSO level and liquidate that equity with a handsome return, pari passu with private equity at a recapitalization event. So they've unlocked a lot of wealth creation opportunities for doctors and actually view doctors as partners rather than employees in today's DSO environment. I think that's an important shift that has really gotten a lot of doctors away from the mindset that DSOs are evil and DSO is a 4-letter word. Obviously, the practice valuations are compelling compared to private practice valuations. So if you're looking at a DSO affiliation, your practice may sell for 2 or 3 times more in the DSO world than it will in the private buyer world. So because of that massive delta in valuation, especially with larger practices, it's caused a lot of doctors to look from an economic perspective at the DSO transition option rather than looking at selling to a private buyer. I would say the shift also to group practice, the fact that this industry is no longer made up of solo doctor practices. I would say up until 20 years ago, that was kind of the trend. I mean, most practices were individually owned, one provider, maybe with a couple of hygienists. But now you've got these mega practices that have 3, 4, 5 doctors, maybe even more, working under one roof, multi-million-dollar revenue practices, a lot of employees, a significant administrative burden to run that business. Those practices are not really marketable to private buyers. So by default, private equity DSOs are really the ideal buyer and the only buyer for that type of practice. Otherwise, you're left trying to stage a transition by selling small pieces of the practice to individual doctors. And that's really, really hard to pull off. There's a lot of moving parts there, and the economics are not going to be near as compelling as they are in the private equity DSO space. And then the last factor is one of the things that I think is causing a lot of doctors to look at partnering with the DSO. And that is the increase in management burden. You have to be more sophisticated from a business perspective to be a successful practice owner in today's time. And I think COVID exacerbated some of that. All the problems we had with being shut down and PPE. It would have been nice to have a partner that could help you solve some of those problems. We've got, upward pressure on overhead. We all know that overhead doesn't go down over time. and we've got downward pressure on reimbursement rates from PPO infiltration into our industry. So those two things are substantially increasing the burden of management. And then post-COVID, I would say the biggest pain point in your practice that we hear daily from practice owners is the labor market. Doctor recruitment, staff recruitment, turnover. That's one of the biggest pain points, if not the biggest pain point that most dentists struggle with. And DSOs have built robust infrastructure. They have a lot of resources and deep pockets to help solve a lot of those problems. So for those reasons, economic as well as from a support perspective, a lot of doctors, especially younger doctors, have looked to affiliate with the DSO. And that doesn't mean selling out to corporate. It means partnering with a larger entity that can help support you on the day-to-day from an administrative perspective and help fight some of those headwinds that the dental industry is currently facing. Just a reminder, if you have any questions, please type the question bottom right-hand corner of the page or text at my cell phone, 512-660-8505. So let's talk a little bit about current market conditions. We get asked this question on a daily basis. Is now a good time to sell a practice? Is now a good time to look at affiliating with the DSO? And the short answer is yes. Practice valuations have increased substantially post-COVID. Dentistry, yet again, has proven to be very strong in the face of adversity. So whether you're talking about the financial crisis in 2008, whether you're talking about the pandemic, dentistry rebounded extremely quickly. It's a very resilient industry. A lot of private equity investors and DSOs already knew that pre-COVID, but seeing how fast dentistry rebounded from the shutdown got the attention of all the private equity firms. I would argue that dentistry is probably the hottest vertical in private equity at the moment. For a while, it was veterinary medicine, dermatology, cosmetic surgery, but today, I'd say dentistry is definitely the hottest vertical, seeing the most attention from private equity investment. So we've seen even more private equity firms start DSOs and come into the marketplace post-COVID. There's currently, this is a shocking number, over 250 DSOs operating nationwide. A lot of people ask, how consolidated is the industry? What percentage of practices are owned by DSOs? There's really not a good statistic out there. We believe that about 15% of the dental industry is now private equity DSO controlled. That is increasing rapidly. So we think over the next 5 to 7 years, that number is likely going to reach 50%, but it's not like private practice is going away. There's always going to be room for private practice owners to be successful in this market. And we still do a lot of doctor-to-doctor transactions, and we see a lot of young doctors that are hungry to be an entrepreneur and pursue practice ownership that do very, very well. So private practice is not dying, but the industry is changing rapidly, and I think it's important for successful practice owners to understand their options. So we've also obviously got a rising interest rate environment. We're not really worried about how rising interest rates are going to impact valuations in the DSO world. We're more concerned about the availability of capital. Interest rates eat into returns from a private equity perspective modestly, but it's really the availability of capital that impacts private equity's ability to continue to bid on practices and to grow from an acquisition standpoint. Recessionary fears have recently, just in the past few months, caused banks to tighten up, and therefore there's going to be less access to leverage for some DSOs from some private equity investors moving forward. So it's really going to come down to, have you built a sustainable business model? Do you have a sustainable deal structure? Are you a good operator? We know there's a lot of DSOs out there that have been successful in aggregating, in buying practices and integrating practices, but can you really operate efficiently at scale? So those DSOs are going to be tested over the next 6 to 12 months. And those that are over leveraged or don't have any infrastructure and aren't really prepared to operate the business long term are likely going to have some leverage issues. They're likely going to have some access to capital issues. So that's the primary concern. That's the primary headwind that we feel that DSOs and private equity are facing over the next few years. We talked about DSOs being tested from an operational perspective. We talked about the demarcation of the DSO marketplace in the sense that there's going to be buyers that are very, very well capitalized, that have a lot of dry powder, that have proven to be good operators, that have proven the ability to aggregate, integrate, and operate. They're going to have plenty of capital. They're going to continue bidding on practices. But those that are struggling are going to be on the sidelines. So we feel that there's going to be a demarcation of the DSO marketplace. The cream is going to rise to the top. And those that are having problems will likely be consolidated, will likely be eventually bought by the larger, more successful DSOs. The last major change that we're seeing currently in market conditions is that as the market constricts a little bit, and don't get me wrong, now is still a phenomenal time to sell a practice. Valuations are still at an all-time high, but we are seeing that DSOs are being more selective about the practices that they're acquiring. So 2 years ago, you could sell almost any practice with revenue over $1 million to a DSO. But I will say that they're getting more and more choosy moving forward for two reasons. One, their banks are paying closer attention to the decisions that they're making. And two, on the back end, when they go to recapitalize, the institutional investors are paying more attention to the quality of the assets within their portfolio. So that scrutiny is going to cause DSOs to be more selective moving forward. All right, so let's talk about why some practice owners choose to sell to a DSO. We mentioned this before, higher practice valuation. So practices, large practices, typically trade for a significant premium in the DSO private equity environment compared to the private buyer environment. So as we all know, from a doctor to doctor perspective, traditionally practices trade for somewhere around 75% of revenue. But in the DSO space, DSOs don't really care about revenue. It's all about EBITDA. It's all about a multiple of the absentee owner profit. What's left after overhead and paying the doctors? They don't really care about top line revenue. So we see practices, large practices, sometimes trade for 200%. 300% of revenue. That's a massive premium compared to what those same practices would trade for in the private buyer marketplace. We see a lot of practice owners looking to de-risk. A lot of people are worried about macroeconomic conditions. They're worried about, sociopolitical problems. They want to take some chips off the table. They want to liquidate a piece of their practice at a favorable valuation and protect that asset. So we're seeing a lot of people use the DSO transition option as a way to de-risk and take some chips off the table. We talked about this before, the increasing burden of management, the day-to-day challenges of being a successful business owner, especially if you own a large practice and employ numerous doctors and a lot of staff. DSOs are designed to help alleviate the management burden and improve work-life balance. But I do want to say, you've got to find your why, right? You've got to define what your goals are. What are you trying to accomplish in a DSO affiliation? If it's economic, fine. I mean, for most people, economics is a major consideration, but for many, it's not the sole consideration. If you're looking for administrative support, if you're looking to alleviate that management burden, if you're looking to improve that work-life balance, you need to partner with a DSO that's got sufficient infrastructure to support you in that regard. Some DSOs have robust infrastructure. Some DSOs have no infrastructure. If the driving force is solely economic, then you might not care. But if the driving force is to get help from an administrative perspective, you need to partner with somebody that's got the infrastructure to make that happen. DSOs take advantages of economies of scale. What do I mean by that? They have buying power. They have leverage with both vendors. So they can buy equipment and supplies for a fraction of what you pay. Normally they get a 30 to 40% discount on equipment and supplies comparative to a private practice owner. They get discounts of similar magnitude with labs, and they can leverage payers. They can leverage insurance companies for better reimbursement rates. So when you talk about increasing the top line from getting better reimbursement rates from insurance companies and increasing the bottom line from leveraging vendors for better pricing, overnight, a DSO partner should be able to help improve your EBITDA. A DSO offers you the ability to continue working your office long-term following closing. So in most DSO transactions, they're going to want the doctors to commit to stay on for at least 3 to 5 years. The reality is they want you to stay as long as you want to be there. So as long as you're happy, as long as you're productive, they want you in the practice. No better person to have as their associate than the former owner. We talked about the fact that DSOs have allowed doctors to participate in recapitalization events. They've brought doctors wealth creation opportunities that are not available to most of you on your own. The ability to invest in a private equity-backed company and liquidate that investment for a significant return at recap is very, very attractive to many doctors. The last one, FOMO, not a good reason to sell to a DSO. But we have, some doctors that call us in a bit of a panic. They have a huge fear of missing out. They think the window for selling to private equity for the sky-high valuations that we've experienced over the past 2 years is closing. I don't think so. So do I think that the window is not, slammed open the way it was a year ago? Yeah. Do I think that things are going to tighten up a little bit and that we may see valuations cool off in the back half of 2023? Possibly. But the window's certainly not slamming shut. All of these private equity firms are on a 3 to 5 year recap cycle. This consolidation is going to continue for at least the next 5 to 10 years, and then we'll see where we go from there. So we think valuations are going to remain relatively robust, and there's going to be plenty of demand for DSO buyers for years to come. All right, just looking at a couple of questions that I'll cover in just a second. Let's talk about what DSOs are looking for. So what type of practices are DSOs buying? DSOs are buying general dentistry practices in all dental specialties. So obviously, starting with the consolidation trend, mainly they were buying general practices. But now we've got some large general dentistry focused DSOs that are starting to diversify. They're starting to buy specialty practices in the geographies where they have general practice density. And then we have seen the advent of a lot of specialty specific DSOs. So there are OMS only DSOs, there's implant focused DSOs, ortho focused, pedo focused. So they are buying practices across the full spectrum of the dental industry, both general and all specialties. I would say that probably the hottest verticals at the moment that are seeing the highest valuations are ortho and oral surgery. They're looking for practices that are within 60 miles of a major metro area. Now, that doesn't mean that if you're further away than a major metro area than that, you're going to have a problem selling your practice to a DSO. It just means that demand may be limited, as opposed to, your practice located in a major metro area might get 7 to 10 offers. If it's in a tertiary market, you might only see 3 to 5 offers. So there are DSOs that solely go after practices that are located in tertiary markets, but most of them want to be within 60 miles of a major metro area. Why is that? It's primarily from a recruiting perspective. They need the ability to recruit talent, doctor talent, and staff talent. They're looking for, TTM stands for trailing 12 months. So the most recent 12 months revenue of 1.5 million or higher. I would say up until about a year, 18 months ago, most DSOs were looking for revenue of $1 million plus. But as they've gotten a little bit more focused on the type of practices that they're buying, I would say that, and as more and more doctors have looked to pursue DSO affiliations, they've started to focus really on practices with EBITDA of 300,000 plus. So a healthy practice is operating at a 20% EBITDA margin. The DSOs want EBITDA of 300,000. That means that your revenue really needs to be around 1.5 million plus in order to be a very, very attractive target for a DSO. Now, many DSOs are still pursuing practices with revenue under 1.5 million. Again, it's just like the analogy metro to tertiary market. If you have under $300,000 in EBITDA, you're likely not going to see as much demand as you would if you were over $300,000 in EBITDA. But no doubt there would still be DSOs interested in your practice. It just may be either national DSOs that have a broad geography across the country, or localized DSOs that are trying to build density in your local geography. Those would be probably the two bidders for a smaller practice versus every DSO is going to want to bid on a practice with 1.5 million in revenue, 300,000 EBITDA or more. They want to see a minimum of 5 operatories. DSOs would prefer to have multiple providers either at the time of affiliation or within a few years. So if you have less than 5 operatories, it's very hard to support multiple providers. So they really like to see 5+ operatories. And as I said before, they really need and want and require the selling doctor and or associate doctors to continue working in the office 3 to 5 years. Up until 2-3 years ago, maybe even more recently, DSOs were really only requiring a 2-year commitment by the seller. But more recently, as DSOs have gotten more selective and more targeted with the practices that they're buying, and they're trying to mitigate risk, they're starting to require that the selling doctors stay on longer than they previously did. So I just had a few questions roll in, so I'm going to address those real quick. So first question, what is EBITDA? Great question. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's essentially an accounting firm, accounting terminology. Think of it this way. EBITDA is absentee owner profit. So if I'm going to buy your practice, but I'm not going to work there, how much cash flow is going to be available to me after I pay the overhead of the business, and then I pay a doctor a market wage to do the dentistry? So revenue minus overhead minus doctor compensation equals EBITDA. We often get calls from docs that say, hey, I'm doing $1 million a year in revenue and my EBITDA is 350,000. And the first question I ask is, well, did you pay yourself? Because it's very difficult to generate a 35% EBITDA margin on $1 million revenue practice. And the answer is, oh, no. Oh, I have to pay myself? Yes. As an investor, the DSO is going to have to pay you to work chairside. So you've got to back out an industry wage, a market wage for yourself and your associates to do the dentistry. With a general dentistry practice, that market wage is ballpark 30% of doctor collections. And in specialty practices, that might tick up to anywhere between 32.5% to 35% of chairside production. So that's an explanation of EBITDA. Let's see, we got one more question coming in. So this question is surrounding that last bullet point. And is the valuation dependent on how long the doctor stays on? And does the owner doctor, if they're not responsible for a massive amount of production, still committed to staying on long term? Here's the short answer to that. They want the owner or owners of the practice to retain some equity, roll some equity, and or have some role in the practice post-closing. Now, that does not mean that you have to work chairside. Most DSOs really don't care about where the chairside production is coming from. All they care is that a competent, licensed doctor is doing the work. So if you're in a situation where you have pushed a lot of the production of your practice to associates and you're only working part-time chairside, there's not a requirement that you're going to have to work more than you work today or hit a certain production threshold. All the investor cares about, all private equity and DSOs care about, is that the practice maintains the revenue level and the profitability that it had when they purchased it. So it doesn't matter who's working chairside and who's producing the dentistry. That will not impact valuation. So there's a lot of flexibility in that regard. So no need to worry if you're not working chairside or you're responsible for a small amount of production in your practice. That's actually a good thing, because in a practice like that, there's less key man risk because the production is bifurcated among multiple providers rather than centralized in one individual. So let's talk about DSO practice valuations for a minute. From an EBITDA perspective, a healthy EBITDA margin is 20 to 25%. So if your practice has $2 million in revenue, in an ideal world, if it's being run efficiently, your EBITDA would be somewhere in the range of $400,000 to $500,000. Practices with EBITDA of less than $1 million typically sell in the range of 5.5 to 7.5 times EBITDA. So let's take that example. We just talked about a $2 million top line revenue practice with $500,000 in EBITDA. Let's say it sells for 7x. So that's a $3.5 million valuation on a practice with $2 million top line revenue. And the valuations tick up from there. So as your EBITDA starts to cross $1 million, you're going to see your multiple tick up. We would expect most practices with EBITDA of a million plus to sell today for 7 to 10 times EBITDA. But the EBITDA threshold is not the only factor that impacts EBITDA. There are a multitude of factors that impact EBITDA, including number of providers. In other words, is it a multi-doctor practice or is it a super GP practice? Is there one doctor producing $3 million a year with a huge expanded skill set, doing all on fours, high-end, full-mouth cosmetic cases? That practice is going to have more key man risk and may trade for a little bit lower multiple than a bread and butter practice where the dentistry is bifurcated between 3 or 4 providers. Number of locations, geography. Again, are you in a major metro area or are you in a tertiary market? Payer mix, PPO, fee for service. Do you have any Medicaid exposure? Private equity tends to steer clear of Medicaid, except in the pedo world. They understand that most pedo practices are going to have a Medicaid component. Service mix, just touched on this earlier. Is it bread and butter restorative dentistry, or do you have a super producer in the practice that's going to be very, very difficult to replace if and when they leave, that has a huge expanded skill set? What's the upside potential of the practice? Is there room to increase top line revenue? Is there room to make the practice more efficient, leverage those economies of scale, and overnight increase the EBITDA of the practice? What are the doctor's post-closing plans? The first question a DSO is going to ask a seller: why are you selling and what are your plans? You need to have a succinct answer in what you're looking for. What is your why? What are you trying to accomplish in a DSO transaction? And what are your plans post-close? Are you planning to sail off into the sunset immediately following close? That's going to make marketability and value a challenge. Or are you looking to stay on indefinitely? And in an ideal world, that's where you're at. We try to limit the post-closing commitment of our clients to 3 to 5 years. But the reality is many of our clients will choose to stay on much longer than that. But we want them to have as much optionality as possible. So we try to limit the post-closing commitment to a max of 5 years. And then your personality. A lot of people think that private equity, DSOs, solely look at value through the lens of profitability, through the lens of economics, through the lens of investment. The reality is they care a hell of a lot about the doctor. They look at doctors as partners. They want to get to know you. And the more charismatic you are during the courting process, it could actually move the needle substantially from a valuation perspective. We always tell all of our DSO clients, let us focus on the economics. Let us focus on the negotiations. Let's take that burden off your plate and allow you to be the most charismatic version of yourself you possibly can be. If buyers like you, it will move the needle from an EBITDA perspective. All right. Relatively complicated subject. I'm going to spend quite a bit of time on this slide talking about DSO deal structures. And that's going to answer actually one of the questions that just came in. These are I'll say the top 4 are kind of the legitimate deal structures that we see every day in the marketplace. The 5th is what I consider to be an illegitimate deal structure, but I'll touch on each briefly. And I do want to let you know, I'm going to do a follow-up podcast where we're going to get very granular on DSO deal structures and really dial down into each of these structures so that you can understand the nuances between them. So first of all, let's talk about what I'll call kind of the traditional DSO model. And this is really, Heartland pioneered this model. So you can call it the old school model, the traditional, DSO deal structure, but you're going to sell 100% of your practice. The DSO is going to give you 70 to 80% cash at close, likely closer to 70% cash at close. And the remainder of the practice value is going to be paid over the course of 3 to 5 years in annual installments, predicated upon you fulfilling your post-closing employment obligation and the practice maintaining the revenue level it was at pre-sale. So that's a very simplistic deal structure in a good way, but the upside from a valuation perspective is very limited. You set the price at close, and then your goal over the next few years is to get 100% of the proceeds from the price that you agreed to. But there's really not a lot of upside. There's not a lot of arbitrage opportunity when it comes to an equity component and recap and liquidation. So let's move on to talking about the holding company model. So in this model, and this is what a lot of the DSOs out there today, particularly a lot of the specialty focused DSOs, this is the model that they use. They're going to buy 100% of your business. They're going to give you 70 to 85% cash at close. And the remaining part of the valuation is going to be invested in stock in the parent company, stock in the holding company of the DSO. So you're essentially, if it's done right, holding the same equity that the private equity investors are holding. And the goal in that scenario is to liquidate that equity at a recapitalization event at a significant return, hopefully somewhere in the range of a 3 to 5x return on your investment. So let's back up there. I just said a word that some of you may not know what it means. Recapitalization event. What does that mean? So private equity, when they invest in a business, they typically want to aggregate and operate and build that business up, make it more valuable, increase the EBITDA level and margin significantly on a 3 to 5 year window before they look to sell that business to the next investor, whether that be another family office, another private equity firm, an institutional investor. So recap cycles are typically 3 to 5 years. And at recap, everybody that's holding equity in the holding company has the opportunity to liquidate that equity in part or in full. It depends on what deal is negotiated with the buyer at recap. But in many cases, you'll have the opportunity to liquidate the equity in full at hopefully a handsome return. What really, really matters when we're talking about a holding company structure is at what point you're entering the recap cycle. What are you paying for that stock? When is the next recapitalization event expected to occur? And what is the projected return on equity? The DSO is going to give us a lot of guidance in that regard. But what essentially happens is the stock is marked up in value throughout the recap cycle so that the early investors that invested early in the recap cycle, it was a riskier investment and they had to hold for a longer period of time than investors that purchased stock near the end of the recap cycle. They will expect that their return is significantly higher than those that partnered with that DSO and bought stock right before a recap event. So if you're entering a DSO partnership in a holding company structure right before a recap, you should expect that your return is going to be muted. At recap, your return may just be, 50% return, 100% return. Still a great return, but a muted return, comparatively speaking, to somebody that entered the recap cycle at the beginning and maybe generating a 3 to 4x, so 3 to 400% return on equity. A joint venture model. So a joint venture model, and I'll say, this is most closely associated with MB2. They kind of pioneered this model in the DSO space. In this scenario, you're selling 60 to 70% of your practice, cash at close, and you're retaining the remaining 30 to 40% equity at the practice level. So rather than investing in stock in the holding company, rather than buying stock in the parent company in the DSO, you actually retain equity within your own four walls at the practice level. So the benefit there is that you're going to get ongoing net income distributions pro rata with your retained equity. So you're going to continue to share in the cash flow of the practice on an ongoing basis because you haven't sold 100% of the business. In the holding company model, you don't have that opportunity because you sold 100% of the business and all of your equity lies at the parent company level. You're no longer sharing in the ongoing profitability within your own practice. So that's why a lot of young doctors really gravitate towards the joint venture model, because they want some administrative help. They want to de-risk and take some chips off the table, but they want to continue to share in the ongoing cash flow of the business. Now, in a joint venture model, you're also going to have the opportunity to participate in a recapitalization event. So typically at recap, you're able to sell up to 50%. There's a handful of DSOs out there that are saying you can sell 100%, but most joint venture DSOs are saying you'll be able to sell 50% of your remaining equity at recap at the parent company multiple. So let's say that you sold 60% of your practice for 7 times EBITDA. That was the initial transaction, okay? And then in a few years, you hit a recapitalization event and you're able to sell 50% of your remaining equity. So you've got 40% equity remaining. You're able to liquidate 20% of that equity, but the DSO is trading at a multiple of 14 times EBITDA. So you're essentially going to double the value of your practice overnight by your equity being tethered to a larger entity. Not to mention the fact that now you've got some administrative support and you've got a partner, in your practice on the day-to-day. So onto the hybrid model. The hybrid model is essentially a combination of the holding company model and the joint venture model. So for instance, the DSO is going to buy 70% of your practice, cash at close, and they're going to bifurcate the remainder of the value into 15% into holding company equity and 15% into joint venture equity. In that scenario, the joint venture equity can likely only be liquidated to another doctor. The holding company equity is what you're going to liquidate in full at recap. So the hybrid model basically offers both equity components of the holding company model and the joint venture model. Now, let's move on to the roll-up concept. So there is a concept out in the marketplace today where whether it's brokers or pseudo DSOs are trying to pitch people on the concept of bundling together a bunch of unaffiliated practices. It's what we call a duct tape DSO. You're going to take 10 practices or even more. Some people are trying to say they're going to do 50 practices, 100 practices, and you're going to bring them together in a co-op, maybe call the DSO, you give it some clever name, and you're going to loosely affiliate, loosely integrate these practices and pretend like they're one company. And you're going to take that to market and try to sell it to a private equity firm for a multiple that's commensurate with what an established, fully integrated DSO would sell for. So the pitch is, hey, doc, you're worth 6 times EBITDA on your own, but by joining my collective, we're going to sell as a group for 10 or 12 times EBITDA. You're going to pay me a fee to join the group, which is $25,000, $50,000, whatever it is. You're going to pay me monthly consulting fees for the integration and support services we're offering. And then if and when we sell to a larger entity at supposedly this huge premium, I'm going to charge you a handsome broker fee, essentially. That concept, in my opinion, is complete snake oil. It is designed to line the pockets of the people that are leading the charge, that designed the concept. They're going to bleed people dry on fees throughout the process with the promise that they're going to hit, a grand slam in the bottom of the ninth with 2 outs of the World Series. It's not going to happen. That concept is not palatable to private equity. The dumb money left the market when interest rates went up and banks started to tighten up. Now, I will say most of these concepts came to fruition in a very, very frothy market. A couple of years ago, when multiple DSOs were eyeing IPOs, the premise was that you could pull off that roll-up concept and sell it to one of those DSOs for a huge premium right before they IPO'd, because they didn't care. They were going to generate a huge amount of arbitrage overnight, even if they paid a premium multiple on that investment. Those buyers have left the marketplace. That concept is no longer palatable. So if you're in that concept, you are holding your breath for something that unfortunately is not going to happen. So please, please do not get caught up in one of those roll-up concept gimmicks. It does nothing but line the pockets of the people that are running the show. We had a question come in. Are DSOs looking to own real estate? And the short answer is no. There are a handful of DSOs, handful of private equity firms that like real estate and will invest in real estate. But most DSOs want to keep as much dry powder as possible to continue to grow the dental business. So if you're looking to sell your real estate simultaneously with your practice in a DSO transaction, some DSOs will partner with a REIT, a real estate investment trust, that will operate alongside them and purchase the real estate. So there are several of those players in the marketplace that partner with DSOs. We have relationships with many of them. So it is possible to liquidate both the practice and real estate simultaneously. For most of our clients, they consider the real estate a great long-term annuity. So if they can affiliate with a DSO, sell to a DSO, and then retain the real estate, they've got a very well-capitalized tenant because the DSO is guaranteed the lease. That makes the real estate more valuable and gives the client, an income-producing asset for years to come that can be liquidated to an investor at really any time. All right, so let's talk a little bit about debunking DSO myths. This first one makes me laugh, but DSOs are evil. So I would say, for the first 7-8 years I was in this business, again, I've been on the sell side for about 12 years, but for the first 7 years, we wouldn't even bring up the DSO option to our clients because we felt like it was a 4-letter word. They would run us out of their office. But because of the reasons we have talked about before, we feel that DSOs have learned to stay in their lane. They've learned how to support doctors. They allow for clinical autonomy, and they unlock a lot of wealth creation opportunities for doctors. So for those reasons, DSO is really no longer a 4-letter word. It's become a much more acceptable transition option than it was previously. All DSOs are the same. I feel like a lot of practice owners, a lot of sellers think that, DSOs are all kind of similar. I mean, just from the exercise tonight and talking about the different deal structures that are out there and how different they are, you can tell. I mean, each DSO is unique. We say this all the time. If you've met one DSO, you have met one DSO. They all have a different history. They all have a different culture. They all have a different private equity sponsor. They all have different financial goals. They're all at a different iteration in their recap cycle. They have different deal structures. They have different levels of managerial pedigree as well as operational infrastructure. So you need to make sure that if you're going to take your practice to the DSO marketplace, you create as much optionality as possible. You need to meet everybody out there who would be potentially a good fit for your practice so that you have perspective. It can make a pragmatic decision on, one, is a DSO affiliation the right fit for your situation and your practice? And two, if so, who's the right DSO out of the 10 or 15 that we might put at the table to partner with? A lot of people are really, really focused on valuation. Valuation. People want to pound their chest and say, I sold my practice for 7 million, 10 million, 15 million. Deal structure and fit are just as important as valuation. A lot of times the second bite of the apple, that stock, that equity component is as valuable as the first bite, as valuable as the initial transaction. Partnering with the DSO that's got the financial wherewithal, the operational fortitude to get to that recapitalization event, that to get to that second bite of the apple at a favorable valuation is critically important. So valuation, economics on the front end, of course, that's important. I mean, that goes without saying. But fit and deal structure are equally important. And fit from the perspective of, are you going to be happy? Is your staff going to be happy? Are your patients going to be happy in the practice post-close? Are you truly going to have clinical autonomy? What changes are going to occur? And how is that going to impact staff morale and the patient experience? You need to evaluate that on the front end. Everyone focuses on the EBITDA multiple. Again, this is kind of a pound your chest moment. I sold my practice for 6x. I sold my practice for 9x. Everybody is so focused on what multiple can you get me, Brannon? In reality, the multiple is important, but a multiple of what? EBITDA moves the needle far more than the multiple. So making sure that you know what your EBITDA is, that we've done a thorough EBITDA analysis, that we've done every add back we possibly can that's defensible, and being prepared to control the narrative regarding EBITDA, both in the LOI stage as well as in the due diligence quality of earnings stage, is critically important. That is one of the biggest services, biggest value adds that we bring to our client, is making sure that we represent the EBITDA accurately, favorably, and are prepared to defend it throughout the process. And that's why most of the people on our team have a finance, banking, accounting background, because controlling the narrative regarding your EBITDA is a critical component of maximizing your value in a DSO affiliation. Another misnomer: more locations equal a higher multiple and a higher valuation. That's not really the case. So, I mean, yes, in an ideal world, if all your practices were doing $3 million a year in top line revenue, you can have as many locations as you want. That's going to be a phenomenal business. It's going to have a sky high valuation. But if you look at it from this perspective, a 5 million top line practice with a single location versus a 5 million top line practice with 3 locations, which practice is going to be more valuable? Highly likely the single location practice is going to be more valuable, because the EBITDA is going to be substantially higher, because the fixed expenses are going to be substantially lower. When you start talking about multiple locations, you're talking about multiple rents, multiple utilities, more staff. It's going to drive down your EBITDA. And EBITDA is the primary driver of practice valuation. Private equity buyers pay more for practices than DSO buyers. And DSO buyers are often referred to as strategic buyers in this world. A lot of people think that I want to be a private equity platform. I want to be the initial investment that a private equity firm is making. I want to be the platform that they're going to build their DSO around. And why? Because they're going to pay me a premium compared to what a DSO is going to pay me. So private equity buyers that are purchasing platforms might pay 10 to 12 times EBITDA, rather than a DSO buying the same practice for 8 to 9 times EBITDA. But what is not often talked about is that to become a platform investment, a viable platform investment, you either have to build out infrastructure, which is going to be very expensive and it's going to burden your P&L. It's going to drive down your EBITDA, or the private equity firm is going to burden your P&L with the infrastructure that they have to build around you in order for you to be a scalable platform. So in reality, private equity is paying a higher multiple on a lower EBITDA number, while a DSO already has the infrastructure. They're going to be paying a lower multiple on a higher EBITDA number. So in many cases, the valuation from private equity versus DSO on the same practice are going to be neck and neck, although one is paying a higher multiple of a lower EBITDA number and one is paying a lower multiple on a higher EBITDA number. So that's often not talked about. It's something that I think we need to be talking more about. It's not necessarily advantageous to be a private equity platform. It's much simpler and much cleaner in many cases to sell to an existing DSO. The last one, I'm in discussions with a DSO, therefore I don't need a broker. That could not be further from the truth. With most of our DSO clients, they're already talking to one or two buyers. Sometimes they already have offers on the table and they come to us and they say, hey, do I really need to engage you? I'm already talking to a couple of DSOs. And we say, absolutely. Simply by us walking in the door and resetting the narrative, resetting the table, leveling the playing field, create a competitive environment, those DSOs that are already sitting at the table, sometimes already with offers on the table, we're able to get them to come up on their offers by 20 to 25%. I mean, there have been instances where we've had DSOs double their offer. A case comes to mind. I mean, recently we were talking with a client who had an offer on the table prior to engaging us, and he seriously debated whether he was going to hire us. And the initial offer was $6.75 million on his practice. And he ultimately decided to engage us. We created a highly competitive environment. We took the practice to 12 different DSOs. 5 of them ended up bidding, including the buyer that was at the table when we walked in the room. The buyer that was already at the table has now offered $10.5 million for that same practice. Ultimately, we think that practice is going to trade for around $11.5 million. So the valuation nearly doubled, even though they were already in discussions with a DSO and already had an offer on the table. At the end of the day, the name of the game for DSOs and private equity is to be opportunistic. And I don't want to say predatory, but opportunistic. You would do the same thing if you were in their shoes. Their goal is to create financial arbitrage for their investors. Their goal is to buy quality practices for the lowest possible price they can. Our goal is to empower doctors to make smart decisions with the most valuable asset that they have and then maximize the value if and when they go to market. The reality is that DSOs continue to buy a ton of practices directly from doctors without representation for a discount. And it's all a cost average game. So if they're going to buy 10 practices and 8 of them they're going to buy directly from doctors without representation at a discount, they can afford to pay a premium for the 2 out of 10 that they're going to buy that are represented by us. It's all a cost average game. It's very simple math. You want to be the guy or girl that's getting the premium. You don't want to be the practice owner that thinks they're saving themselves a commission. They're stepping over dimes to pick up pennies, and you end up selling at what you thought was a good valuation, but was actually at a substantial discount. Bear with me just a second. A couple of questions coming in. Do you still have the benefit of writing off personal expenses, discretionary expenses, post-affiliation with a DSO? And the quick answer is it depends. It depends on deal structure. Typically in a joint venture structure where your equity is owned at the practice level, you can own that equity in an LLC or whatever entity your accountant advises, and continue to write off your personal expenses through that entity. So your pro rata net income distribution would flow into that entity, and then you would write off your personal discretionary expenses at that level. So you don't lose the tax benefits in that regard. Another question came in: is placing our practice in a trust reduce our federal and state taxes associated with the DSO sale? I have yet to see a legitimate way to protect your practice, your proceeds at the time of close from taxes. Now, our goal is to mitigate the tax burden as much as we can, allocate as much as we can to goodwill, which is taxed as a capital gain. And DSOs are very, very flexible in that regard. But utilizing trusts, whether it's deferred sale trust or what have you, I would be very, very careful. That's a gray area from an IRS perspective. Many DSOs, if they find out that you're trying to skirt taxes through using a trust, will actually not proceed with the transaction because they feel like there's liability issues on your part and their part. But I'm not a CPA. I'm not a tax attorney. You need to consult a highly sophisticated tax attorney to ask that question and go by the guidance that they give you. But don't consult some company that's out there pitching a product designed to skirt the tax ramifications of the sale of your business. Get referred to a trusted tax attorney. All right, real quick, keys to maximizing your outcome in a DSO affiliation. You've got to have proper representation. You've got to have a sell-side advisor at the table. And I say sell-side advisor because I'm not talking about your old school mom and pop dental practice broker. I'm talking about somebody like us that day in, day out, we live and breathe the DSO private equity world. We're constantly negotiating these transactions. We know the ins and outs, the complexities, and we know the players at the table. A big part of what we do is vet DSOs constantly. Who has capital? Who has infrastructure? Who has managerial pedigree? Who's got a strong chance of accomplishing their financial goals and reaching a recap at a attractive financial return? This is what we do daily. So you've got to have proper representation. You got to have a sell-side advisor. You've got to have a really, really strong dental attorney that's got experience in handling DSO transactions. Your CPA needs to be at the table to help advise you on the tax implications and purchase price allocations. And then typically you want to consult your financial advisor and make sure that, moving forward with a DSO affiliation, liquidating all or a part of your business is a wise move at this stage of your life. Now, if your decision to sell is not solely economic, it may revolve more around quality of life, balance, infrastructure, and support. And that's okay. But you need to make sure that you've got all the right people on your team at the table to advise you in every aspect that you need to consider in making the decision, one, to sell to a DSO, and then two, what deal structure, what economic outcome is ideal for your individual situation. You've got to clearly define your goals. Start with why. What is your why? What are you trying to accomplish? Why are you interested in pursuing a DSO affiliation or a private equity partner? You've got to clearly define that before you ever start to have serious discussions with a buyer. You need to understand your options. We've talked about a lot of different DSOs, a lot of different deal structures out there. You need a full scope of perspective on what's available in today's marketplace. You've got to control the narrative regarding EBITDA and practice value. If you don't, you're going to get taken advantage of. You would think that EBITDA is completely objective, that if you sent your numbers to 10 DSOs, they'd all come up with the same EBITDA. The reality is the EBITDA will vary remarkably from DSO to DSO. They all make their own adjustments to EBITDA, and some of them allow for add backs where some of them don't, and vice versa. So having somebody like us at the table that can control the narrative regarding EBITDA is key. You don't want your buyer telling you what your EBITDA is. You don't want your buyer dictating what your practice value is. You've got to create a highly competitive environment among multiple DSOs. So There can't just be one buyer at the table. You can't respond to an unsolicited offer. You can't just call a DSO because your buddy recommended it because he sold to them, or you need to do your homework. You need to have a lot of optionality at the table in order to have perspective on what's out there, and then leverage that competition to maximize your financial outcome. So you need to get multiple offers. At the end of the day, our goal is to identify who's the buyer, what's the deal structure that is the ideal fit to accomplish your why, and then leverage that highly competitive environment to negotiate the best financial outcome with that particular buyer. So just got a good question that rolled in. When calculating EBITDA, are you using current numbers, or are you talking about future potential after joining the DSO? So that's a fantastic question. So when we look at EBITDA, we're looking at historical EBITDA, based on how you're running your practice. Now, we know that DSOs are going to leverage economies of scale to potentially increase reimbursement rates, so increase the top line, and then drive down the cost of dental supplies, equipment, lab, employee benefits, things of that nature. But we can't really adjust for that. DSOs won't allow us to adjust for that. They'll make up for it in paying a handsome multiple for the business, but they won't necessarily adjust for that. I will say, though, that we are very, very good about fighting for add backs when it comes to discretionary, personal, and non-recurring expenses. And then in situational cases, adjusting for a decrease in dental supplies. I mean, we know if your dental supplies is running at 10% of revenue, there's no way a DSO that has leverage, that has economies of scale, is going to continue to run the business in that manner post-close. So we may adjust dental supplies down to 6% and then fight for that adjustment. That's going to increase EBITDA substantially. It's going to increase valuation substantially. The other thing that we do is DSOs are evaluating growth potential. So if your practice has robust growth potential, if you're about to add another doctor or expand the facility to add a couple more ops, we're going to negotiate what we call an earn-up, predicated upon future growth. So the future growth of the practice in the year post-close, you actually are able to participate in a higher payout, an additional payout on valuation predicated upon growth post-close. So we're often able to negotiate an earn-up in addition to the base valuation predicated upon the EBITDA at the time of sale. So that's something that we negotiate, I would say, on 75-80% of our transactions. So let's talk a little bit about McLaren's process. This is how we work. So everything starts with a discovery call. We schedule a call, a consultation to get to know each other better. We want to learn about your practice. We want to get to know you personally, professionally, talk about your goals, and see if it makes sense to entertain the DSO option. From there, we move on to a detailed EBITDA analysis and valuation. So we're going to run the numbers. We're going to really get to know your practice intimately from a financial perspective. We're very detailed in that regard. We've got a dedicated analyst. We've got a CPA on staff. We're going to ask a bunch of annoying questions to make sure that we're seeing your EBITDA with clear perspective, and we've got every add back that we could possibly have in there that's defensible and explainable, so that we present your practice in the most favorable light and get the highest valuation when we go to market. Once we get through that EBITDA analysis, once we complete that valuation, we have a call or a meeting to go over it and discuss options. And at that point is really where we run some financial models. We'll run a no-sell scenario versus sell scenario. We can run financial models predicated upon different deal structures to show you, based on your EBITDA, based on the valuation we think we can fetch in the marketplace, this is how things would play out economically compared to a no-sell scenario. Because I want to make a point. Not selling is always an option. Doing nothing is always an option. We offer completely objective advice that's designed to do what's in your best interest and take your practice to market when it makes sense, and when it's the opportune time, when it's got the most value. If and when we make the decision to take the practice to market, that conversation regarding valuation was a private conversation between us. When we take the practice to market, we utilize a bid process. We do not set a firm asking price on the practice. We found that we get a far better economic outcome when we don't set a firm asking price. And in environments where valuations are changing rapidly, for instance, when we were coming out of COVID, valuations were changing very, very rapidly. So that was actually the point in time when we decided to pivot to a bid process, because valuations were escalating so quickly that it was very unpredictable what DSOs would pay. And one DSO to the next, it was very situational. One DSO might bid $2 million higher than the other three people at the table. We didn't want to leave that value on the table. And now we're entering a little bit more of an uncertain environment in a different way. We've got some adverse, economic conditions on the horizon. We've got rising interest rates, and that is causing some DSOs to pull back while others are very aggressive. So we found that utilizing a bid process is a way to ensure that we don't leave a single dollar of value on the table. We're going to create a highly competitive environment among multiple DSOs. On average, when we take a practice to market, we're getting 5 to 7 offers. We'll normally take it to somewhere between 10 to 15 DSOs. That's out of those 250 DSOs in the broad marketplace. Who are the 10 to 15 DSOs that we feel would be the best fit for accomplishing your why and are going to be most aggressive from a valuation perspective? That's how we run our process. We're going to give you a list of questions to ask DSOs. We're going to be there for the initial meetings, the initial Zoom calls with those buyers to help guide the conversation and make sure that you're interviewing and vetting those buyers as much as they're interviewing and vetting you and your practice. We're going to obtain and compare multiple offers. Once all the offers come in, we'll go back to that financial model. We'll model out all the offers and show you how they compare from an economic perspective on a 5-year window typically. We're going to help you determine which DSO is the right fit for your practice, and then we're going to leverage the competition to negotiate the most favorable economic outcome from the buyer that you deem to be the best fit. And we're the quarterback of the process from start to finish. We're your advocate. We're your guide. We hold your hand from start to finish with the sole goal of getting you the best possible outcome. So I appreciate you spending some time with us tonight. We covered a tremendous amount of ground. We're going to have a few follow-up webinars to get granular on DSO deal structures, as well as address some of the other questions that came up tonight that I didn't have the opportunity to address. Following this webinar, you're going to get prompted to go to our website and fill out a free consultation form. If you're considering a DSO affiliation, if you have questions that we couldn't get to tonight, I encourage you to reach out. We're here as a resource. You will never feel any pressure from us to go down the DSO path or to sell your practice. But if and when you do so, we want to make sure that you're protected, that you have proper representation, and that you maximize the outcome. Hope you all have a great evening, and look forward to talking to you soon. Take care.